Hey, what's going on everyone? It's Alwyn here. I hope you guys are all having a wonderful day as always. Instead of stimulus updates, I'm going to be going over and summarizing last night's Mad Money, which was Monday, March 22nd. So let's get right into it. So I have a list here that I'm going to go ahead and put up on my screen so that way we can screen share and kind of go through this together so that way it's nice and summarized. So before I get into it, make sure that you guys do go ahead and subscribe to Action Alerts Plus, which is Jim Cramer's, he has his travel trust there, his real money columns. He has some really, really good content. So make sure you go to subscribe to him. He's a really good guy. I really like his content. And I'm not going to disclose any of that because it's a subscription-based thing, and that would not be correct to do. So I'm going to be going over his Mad Money last night and kind of what he went through. So let's start with the top, Dow Jones, okay, up, 0.32%, S&P 500 was up 0.7%, NASDAQ was also up 1.23%, so a pretty rare day, right? So how we kind of got into this, let me actually before just kind of get into, because most of you guys probably want to hear, what was his, buy, sell, and hold recommendations. So what is he saying to buy right now? In terms of buying, he's saying, guys, we want to focus on the cyclicals. This would include financial, banks, Wells Fargo's one he's been talking about lately, especially once it drops down to the $36 range, which he said today morning. Really, I would be a buyer. That's what Jim Cramer said. He's also looking at industrials, which we'll get to talking about once we get over here. Union Pacific, Nucor, Boeing, Ford, GM. We have, Southwest, United Airlines. We have Roblox, which we'll talk about, Marvell, and things like that. Those are all going to be buys, and they're going to be on his buy list. A hold would be Airbnb. This is, I think, on his lightning round. And then sell, you maybe want to take, since, on Monday at least we had, the NASDAQ kind of popped up there. What we'll talk about is this counter trend rally, right? We saw one of those. We'll get to that in a second here. But whenever tech kind of spikes, whenever NASDAQ kind of spikes, what he's saying is that it might be beneficial. Hey, sell some techs into profit, right? Take that money from growth. Maybe you made some profit off of a new SPAC, maybe SPAC 1, 2, 3, 4, 5, whichever one that is, celebrity SPAC. Take your gains, cut some of those profits and maybe invest it into some of these cyclicals, some of these financials, industrials, where there's an acute shortage, which we'll get to here. So that's kind of like what he's talking about buying, selling, and holding. But I just thought I'd brief over that before jumping into it. And it's just kind of all across from lightning round to even calls that came in between. Okay, so the first thing that he really got to here was the counter trend rally, which is kind of the first thing we want to talk about. Right, so what I have here is that tech got slammed. Tech has been, I should say, over the past 7 weeks, tech has been slammed completely, while the cyclicals, industrials, and banks have been soaring completely, right? And today, or I guess, yesterday, what we saw on the 22nd Monday is that there's a counter trend going on, right? The counter trend is something opposite than the trend. What was the trend? Well, we saw the trend, techs were getting slammed, cyclicals were soaring, our reopening trades were soaring. Right, and it was the day that we saw, yesterday was the day we saw the NASDAQ rise by 1.23%. Banks and industrials in this, in the usual trend can do anything wrong and is totally fine or perfectly fine since they're reopening, and we'll get to banks in a second. Well, in this market, tech, even if it releases, a good quarter, Salesforce, Nvidia, AMD, like they've come on and show a lot, but people react very negatively, right? Tech can do anything, and they'll always be wrong or penalized during this time. So that's the first thing he really wanted to get across. But yesterday was a counter trend day, meaning that, hey, the NASDAQ did go up. So when this is the case, he's saying even now, it's some time to maybe take some profits and go ahead and put it into some of those industrials, reopening cyclical plays, so that you can really play this trade and still make some money while the NASDAQ is kind of getting hit here. Okay, so that's the first thing. And then we see here, now we see, as of yesterday, tech did get a breather, which was good, right? But what we have to realize here is that we covered counter trend rally is the money managers, right? What are the institutional money managers doing? Well, they're closely watching the bond market, which is the the most important thing that they're looking at. And they fear, this booming economy because of the stimulus, because people are getting back to work. Unemployment rates are going down now, but it's still double pre-pandemic. I think it's at 6% now. But they say that all of these events, all of these macroeconomic stuff, especially the bond market, is going to be, unstoppable. We're going to see unstoppable inflation, right? Because there's so much stimulating the economy now. And the stimulus bill just passed, and the money's coming into people's bank accounts, and everything is reopening. So there's going to be so much spending and things like that, and a lot of this money is going to be in the market. So there's going to be a lot of inflation that's going on. Now, why is this a huge problem, right? Why is this a huge problem? Well, we know from the bond market, bonds give you an interest rate, right? And what happens is that if there's a lot of inflation, the feds have to tighten that interest rate, right? So if they tighten the interest rate, you buy a bond at maybe, let's just say, at 1% yield, you bought it some time ago when interest rates were probably, near zero, whatever, right? But now the problem is either, inflation starts to tick up, maybe like inflation now, it's, ticking up 2%, 3%, whatever. Well, then if your bond only has an interest rate of 1.5%, you're losing money by holding onto that bond. Or if you know the interest rate will go up as it's going up now, you want to sell the bond and get in at a higher interest rate, so that way you're getting more money or you're getting paid out more in income, right? So that's what's going on. People are selling bonds. And why is this? Because the inflation fears. That also transfers directly into the stock market, specifically for these growth stocks. And that's where the money manager is coming. Money managers, these institutional guys, well, they're looking at the unstoppable inflation. Even though Fed Chief Jerome Powell is saying that, guys, there will be transitory inflation, which we'll get to shortly here, which just means that the inflation that we're seeing, yes, it exists, but we're doing it because people are not able to put food on their tables, right? So the transitory means that it's short term, it's short lived, meaning that, yeah, maybe in 6 months down the road, we don't exactly know when, it won't be as much of a problem anymore. So don't worry. But that also sometimes you'll see, like, Jerome Powell speaking at 2 p.m. Oh, stock market tanks or, goes down 1 or 2% after he speaks, right? But that's kind of a touch on what the money manager's doing. And then the main thing is that inflation just weakens tech and weakens growth in general, right? While tech goes down by inflation, essentially what it's doing is it's eroding the future earnings, which is what all growth stocks trade on. Like, we know all these SPACs, they're trading on, 2025, 2026 is the magical numbers. We'll have this much in, revenue, sales, whatever it is. That's kind of the magical number that they use. But, with inflation, those dollars aren't worth as much anymore in 2025 in today's value, right? So the purchasing power of those dollars is a lot less. And that's why the earnings or the revenue, all the numbers that they're predicting for 2025 isn't that much if inflation is pretty big, right? So that's the thing. Jim Cramer talked about long dated paper assets are the ones that are affected. And in this category are things like growth stocks and tech specifically, right? But the younger investors, what we really have to focus on here is that the younger investors are getting stimulus checks now. And they have never really, lived through or experienced in the market a time with elevated inflation, right? So they don't really know, or they just don't care about kind of what's the deal, what's going on, right? They don't care about the bond market. They don't want to look at the bond market. Hey, I got my Tesla, I got my GameStop, and, putting in money there and just let it rise, right? Let it go to the moon is what they're saying, right? So it's important to get both perspectives to kind of understand why the market is doing what it is. And then we'll come back to the idea, right? So Jim Cramer wraps up this part right here with this quote that I want to quote, and I quote here, "If you want winners right now, that means playing the trend, not the counter trend," okay? Counter trend meaning it's the NASDAQ, right? It's the tech-heavy stocks. You don't want to be in those. You want to still ride the cyclicals because there's still, fear, at least in the bond market, that inflation is rising at a fast rate, despite what Fed Chief Jerome Powell says and Janet Yellen will say. Okay, so that's the counter trend rally. Essentially, is that the normal trend? What was the trend? Usually the trend is that cyclicals reopenings are going into strength. Tech is kind of falling behind, being put on a standstill or even getting hurt because of inflation fears, right? There's an inflation scare that's happening, which is driving down tech because they trade on future earnings. That's what we're seeing there. The next thing that I found was really, really nice and I enjoyed a lot was this idea of scarcity, right? So we have to kind of get into this idea of scarcity value, which is pretty important, right? When the Dow is down, what he says is that you get really, really good buying opportunities in these big cyclicals that have been, falling lately in the past, right? The industrials have been picking up lately because why? There's not enough, right? We know supply and demand, right? When you have a lot of demand, what does that mean? And you have limited supply, well, then the price is going to be very high, right? And that's what we're seeing. There's very few names that I'll touch on here that are available to us, right? And because there's so few names, that means that everybody's pumping the money into them, right? So that's what we're kind of looking at here. So it's all kind of a game of this, scarcity, right? So it's the game of scarcity, and we're looking for which one has more value. So a couple things, there's 3 things that he specifically points out in, our scarce sectors in the industrials, right? So we have farm equipment, railroad, and engines, okay? So for farm equipment, he says the biggest one is obviously Deere, right? Deere is very, very important. And he says just in general, covering farm equipment, these stocks, these companies have suffered for many, many years. Like historically, they've faced a lot of consolidation too. So there's only like, there should be a lot once upon a time. Over time, they're just merging together. And now there's so few. And Deere's one of the best ones that he points out there that we can have. So a lot of money going into reopening, but there's only very, very few stocks, right? Whereas when we look at tech, there's so many SPACs, there's so many, IPOs, there's so many direct listings, there's so much supply of stocks. And whereas you come here, because in the past they haven't been doing good, these cyclicals, or I should say these industrials, only do good in times of strong economies, right? So the economy has been really bad over the last year, so they've just been consolidating. Even the past decade, I would say they're just consolidating, right? Because the economy wasn't too strong for them, or it wasn't too good for a position like them, but it was for tech stocks. But now we're seeing them coming back, but we have to realize there's only 2 or 3 companies here that are really good that everybody's funneling their money into. Right, so that's kind of the deal we're seeing. Then we have a couple railroads. In terms of what's important with railroads, there was some wild action yesterday in terms of, the last independent railroads, right? Kansas City Southern is being acquired by Canadian Pacific for $25 billion. And this essentially is big. Why? It only leaves here this 3 major railroads, right? We have Norfolk Southern, which is NSC there. We have, Canadian Pacific, which is CSX. And then we have Union Pacific, which Jim Cramer did disclose that his charitable trust does have Union Pacific. And they were scaling into it. Okay, out of the 3, he says that Union Pacific is the best, despite this, now competition, greater competition, I should say, with Canadian Pacific and their, them acquiring Kansas City Southern. They think it's still better. Why? Now there's only 3 railroads instead of 4. So again, the money's getting funneled into fewer and fewer companies. That means greater scarcity, meaning that when everybody's turning to reopenings, cyclicals, which are these industrial plays such as railroads, they're going to, reap the benefits, even though they might be already priced pretty high, right? That's one thing that's pretty important. These companies are, they're up like 30%, 20, 30% year to date, which is huge. So these companies have went up 100, 200, 300% since the bottom of the pandemic, since the bottom of the market, which was exactly 1 year ago. Today's the 1-year anniversary. And then finally, he talked about engines, how we have Caterpillar, we have Cummins, and then we have United Rental there. Those are all good companies for engines. The biggest thing he wanted to highlight here is not only do we have a few good companies, right, for all of these, but in the last 10 years, he specifically highlighted it with these 3 companies. They've been buying back around 15 to 25% over the last decade of their share value, right? So that's a pretty big deal. So not only are there few companies that everybody's funneling their money into, but the number of shares is also limited, which is pretty big deal. So like we can see there's scarcity. The demand is very high. People are trying to put their money in there, but their supply is so little, which is going to drive the price like crazy, right? So that's what he's saying. That's kind of the arbitrage we want to focus on now, or the growth we should be focusing on, right? And then the really important point that I picked apart was, this S&P 500 inclusion. What he was saying by this is a lot of these stocks are, within the S&P, right? So what does this mean? Or sorry, in these index funds, right? In the S&P 500 index funds. So what does that mean? A lot of times these funds go to, buy them. Well, then all these companies are getting even more funding because these are very large scale. 50% of the market comes from like these index funds / ETFs, right? So just because they're, a lot of these companies are included in the S&P 500, they get that advantage too. So there's even more demand on top of that that's driving it, right? And then the main thing that, I want to quote here is, Jim Cramer says to stay diversified, right? If you only own tech, he says you're going to miss out on the reopening stocks, right? Scale out of tech into strength. So a day like yesterday when the NASDAQ went up, that's your opportunity to sell. Like most investors, myself included, you see it going up, you want to buy more because you think it's, oh yeah, we have a V shape of the recovery going on, whatever it is, and then you think you're too late, so you want to catch the bottom and things like that, right? But Jim Cramer's looking at the bigger macroeconomic picture, understanding younger investors, newer investors, institutional managers, and overall, he's saying that, hey, it's probably better to stay diversified. Okay, if you're only into tech, consider now, selling some of that gains in your tech and, kind of scaling into some of these industrials. And there's a couple names here. So that was his talk on scarcity, which I enjoyed a lot. And then he went on to Roblox, right? So I thought Roblox was really interesting. Essentially, it came public via a direct listing, okay? Not too important there, but essentially what that means is that they don't issue any new shares. all they're doing is they're just issuing current or old shares. It's usually a lot cheaper than a general IPO, initial public offering, right? But, kind of the main thing about, this Roblox is that it's kind of a gaming, software development, and social network, right? So there's a lot of flexibility here, a lot of different things that really makes it good, right? So one thing that I want to cover is that Roblox, was just kind of, listed fairly recently, a week and a half ago or so. And it's been, a pretty choppy run, I would say. But this is, mainly because it was released into a hostile environment, right? At least for tech, say, right? However, this would have been like, Jim Cramer says, a turbocharged company, growth company, if it were just, released or, launched a few months back, right? When there was all this noise, free money flying in from everywhere, checks flying in and things like that. And inflation fears weren't there at the time because unemployment was a lot higher. Well, then that would have meant that, it would have done a lot better. But now it is, kind of bumpy just because it's kind of, classified as tech, right? It's kind of like, like you said, it's gaming, software development, social network. The kind of the opposite of a reopening, right? When we think about the pandemic ending, we think about going outside, booking our Airbnb, going to Disney World, right? Traveling, using Boeing planes, Spirit Airlines, things like that. Not playing more video games or anything like that, right? So it wouldn't be a reopening. It'd be, classified more as a tech, kind of tech-heavy play. So he kind of warned investors of that, right? And keep in mind the comparisons, which we'll get to here. But that's kind of like an overall, what does it really touch on? What is Roblox? You guys can see that by yourself. But mainly it's gaming, software development, and social network is what it's focusing on, right? So think about it essentially like digital Legos is what he says, right? Digital Legos where you can kind of build things and kind of share it with the entire world, right? Instead of just 2 or 3 friends, now it's on a scale of like 10 million people. So it's a very, very big deal. And then he goes into talking about the Roblox currency. Roblox has their own currency, Roblox, right? And essentially what they do is that people, can convert these Roblox into actual US dollars. So users can sell their own content that they're creating, but the company will take a cut of that. So that's another, kind of stream of income that the company will be making through these Roblox, through the Roblox currency itself. And then a main one is Roblox Premium, which they have their free version, but then they also have Roblox Premium, which essentially lets you to buy discounted Roblox and gets you special features on their webpage or their gaming platform, right? And what really sets it apart that I really, really want to highlight here, guys, is the safe platform, right? This is something that Cramer says is very important, especially in today's world. He's talked about this in the past with the be nice or leave movement and things like that. People want a lot more cleaner internet, right? Twitter's moving towards it. Pinterest is already there. All these social media, companies, except for Facebook, I should say, want a more cleaner and kind of contained kind of form of social media and networking, right? And that's what we see here. One statistic that he said was very important is that 54% of their user base, their gamers, are under the age of 13. So we have to make sure that, it is appropriate. Other parents don't want to use it, and it's not going to be like a huge market there. So what they do is they have text filtering, they have, things like content moderation by actual humans. Hear that, actual humans. There are 2,300 people monitoring this. So it's very safe, and, they're making sure that, all the content that's going through is child appropriate, essentially, which is very, very good in today's world. So that's something that's really important, having that safe platform in place. In terms of the numbers, 171% they were, booking growth, year from last year, I should say. The daily active users increased by 85% from 2020. Average hours of engagement is up 124%. However, keep this in mind, this is not as sustainable. This is very important. Why? Average hours engaged, this metric has to go down, right? Like we were inside, we were locked up for so long, and there was this huge spike, 124, more than doubling, almost, 1.25, So it's a huge uptick, which will come down. It's not sustainable, especially given that everybody's going outside, everybody's hanging out with friends more. People just want to kind of be in person more, especially as people get vaccines and it gets a lot safer, right? And then the main thing is that Jim Cramer points out is that, guys, Wall Street loves to look at comparisons, right? And the comparisons for this will be, garbage. Same with all the other tech companies. Why? Especially Zoom, right? They were roaring, last year during this time. Market crashed, and then they spiked, right? March 23rd of 2020, and then after that, they just took off to the moon, right? But now they have to compare against those and like, hey, people don't want to be on Zoom anymore. They're kind of tired of using Zoom for a year. So people are, the engagement times are going to be less. Same idea on Roblox, right? People use Roblox so much, their parents, Jim Cramer says, use it as like a babysitting tool, right? To get their, kids to just focus on something, so that way they can do their work while their kids are doing something else and not bothering them. Same idea with Roblox, right? Kids are going to want to switch after doing something for so long. So their comparisons are going to be very hard because they're not going to necessarily beat all of these numbers because people are now, going in person more. People don't want to spend as much time on video games. So this is something that Wall Street really focuses on, and it really does get beat down on, right? So then I guess the next main thing is that how, Jim Cramer really likes their business model, right? He says you can hook people. If you can hook people when they're young, you essentially hook them for life, right? And then what Roblox, they say is that people will start to go from content consumers as you start off on the platform to content creators, and that's really how they hook them for the long term. Right, so the main thing is that they will have, negatives. They will have, incredible numbers, right? They already have that are kind of unbeatable, and that's where these ugly comparisons really come from. And then, if there is any slowdown, which there most likely will be because tech is facing a slowdown, cyclicals are kind of booming, then what does that mean? A slowdown for the stock is going to be expected, and that means they're going to drop probably further, right? However, if this doesn't really come and inflation is proved to be transitory, like Fed Chief Jerome Powell says, then things will get a lot better, and Jim Cramer says this will be a very strong performer, right? In terms of valuation, we kind of, touched on this here, but, what I would say is that Jim Cramer pointed out, pay no more than $83.50, and why does he say this? $83.50 is exactly 20 times next year's price to booking, okay? And let's just write booking, ing. Okay, so I'm not going to cover that because it's going to take some time to get into what price to booking is. But just relative to other companies, what I would tell you it is that it is expensive, right? And if we compare it to Snapchat, it's pretty much similar in terms of the price to booking ratio, which is around 17, so a little higher there. But when we look at Unity software, it's much cheaper than Unity software, which Jim Cramer says is something that millennials really like today. So that's one thing that he really wanted to focus on. Pay no more than $83.50 as of now, not until later. But he says, as of now, until we get more visibility on how the year will play out, kind of see how inflation will play out, then take a step further. But what he said, the main thing is that, wait, if you're, kind of scared, you're kind of, you kind of get scared, if you're taking a little risk here, he would say just wait unless you're prepared for turbulence. Why? Because he wants you to focus more, diversify your portfolio more into Dow kind of stocks, right? More of the Dow index kind of, industrials and bank stocks, and go away from tech for now if you don't want to withstand that much pain, right? So that's kind of Roblox there. That was very interesting, very good, section there on Roblox. And then finally, to wrap this up and to put, all of this into picture, kind of get both perspectives, is the no huddle offense, right? Kind of looking into it now. The main thing is that we have stimmies versus bonds. Stimmies are just stimulus checks, right? So now we know that most stimulus checks will be flowing into the markets or into stocks, right? We know that from stimulus checks 1 and 2. Majority of people put their money either into Bitcoin or into stocks, right? This happens, and this, coincidentally happens as the bond market starts to scream to sell all growth stocks, to sell tech, right? Because of the inflation scare, because of the inflation fears. What does this cause? This causes a wonderful tug of war, right? Where we see young investors who just don't really care, right? The young investors, like I said, they don't really care about bond market. They're not going to follow the bond market, right? Whereas institutional money managers are a little different, right? Like we talked about before. For example, he gave a very good example of Tesla stock. When people get paid their stimulus check, oh yeah, there's my, fractional shares, 1.5, whatever it is, one, to share of Tesla, how much ever. But people, especially the younger people, younger folks out there, they just throw their money into Tesla because it's absolutely loved by the new generation. But keep in mind that Tesla has fallen from $900 to around $650 as of today, right? And even as of last Friday. One important thing to point out is that Cathie Woods did give a price target. Her base case was $3,000, okay? Her bull case was $4,000, and her bear case was $1,500, which is more than doubling by the year 2025. Okay, so that's important to keep in mind, 2025. Okay, Jim Cramer was a little skeptical about it because it was pretty up there, right? It's more than doubling, and it's already at, 600, 700, $800 billion market cap. So that is pretty tight there. On the other hand, the investors, the institutional money managers, what are they saying? Well, they're like, they can sell whatever, Cathie Wood said, yeah, they'll be selling, $5 to $10 million 5 to 10 million cars at a very low cost, you know. But this is, guys, this is meager in front of the future of raging inflations in their eyes, right? They're saying, yeah, you know, okay, you're going to have robo-taxis, you're going to have 5 to 10 million cars, you know, at a very low cost. Those are all good things by 2025, you know. Robo-taxis, you know, a lot of people have been saying is that, you know, they're a little skeptical of it. But, you know, Elon Musk, we can't be skeptical of him because whatever he really wants, he'll be able to pull off, right? But what they're saying, what these institutional money managers are saying is like, you know, no, we don't even like, you know, okay, what Kathy Woods is saying is okay, but we don't care about that. Why? Because there's a much bigger problem in the face, which is raging inflation that's going to cut down a lot of these future earnings, right? These companies are trading on their future prospective earnings, right? So Jim Cramer goes into the bottom line here, which is the bond market always will, I mean, not always, but the bond market in this case will decide who wins this tug of war between, you know, young and institutional money managers, okay? So really focus on the 10-year treasury, look at how it's moving, and the biggest thing is to diversify into your Dow, your industrial/financial stocks. That was the biggest thing of this episode on yesterday, which is Monday, March 22nd. Hopefully you guys all enjoy this video, kind of a different style video. Make sure to go down below and drop a like if you did enjoy. Subscribe to my channel if you're new. Turn on those post notifications so that we're aware of when I do upload my next video. Comment down below. Till next time. Peace.